Hello, everyone. Welcome to the Wealthspire Retirement Advisory's 2026 Investment Outlook. I'm Joel Shapiro, the president of Wealthspire Retirement Advisory. I know we're a bit of the ways into January, but I wanted to wish everybody a happy new year. I hope you had nice holidays. Before we dive in substantively, if you have questions, please place them in the Q&A. You can find that under the More button at the bottom of your screen. I'm really excited today to introduce an individual to all of you. As you might be aware, at the end of last year, Wealthspire Retirement Advisory, which was previously a part of NFP Retirement, went through a transaction which brought 5 premier organizations together. And that's allowed us to grow and enhance our capabilities. And one of those areas was the capability of increasing our existing investment team, foremost of which was the naming of our new Chief Investment Officer for all of Wealthspire, and that's Brad Long, who you see joining us today. Brad is formerly the CIO of Fiducian. He's going to provide us with a market outlook and strategic insights for 2026. And at the end, I'll rejoin and wrap up the remaining time with a brief ERISA update. So with that, I'm going to turn over the mic to Brad, and Brad's going to take us through the next few slides. Thanks, Brad.
All right, well, appreciate it, Joel. And good morning or good afternoon, everyone, depending on where you're joining us from. So as Joel mentioned, I'm Brad Long, Chief Investment Officer here at Wealthspire. I'm really proud and excited to talk about 2026. And we'll look to connect the dots for you on what's going on in markets, what that means to you as a plan sponsor, or what that means to you as a participant. As a brief reminder, Joel mentioned the expanded resources that we have available to our investment team and our investment advisors and the potential benefits that it brings to you all. And one of those is the annual outlook. Each year we build long-term capital market assumptions, 10 and 20-year forward-looking capital market assumptions, right? Those often rhyme with the kind of life cycle and time frame of which participants are looking to save for retirement. And through that process, we're able to reverse engineer a couple of key themes that we see most likely influencing what's going on in the coming year in 2026. So we'll go through those elements briefly with you. Again, if you've got questions, put them in the chat window. If we don't get to them in this conversation, we'll follow up with you after. But we've got a lot to cover in a short amount of time, so we'll jump straight in. So first thing is our 2026 outlook. It's entitled the Disciplined Dividend. It's an environment and a period of time in capital markets and the economy where we think that there still remains opportunity for great outcomes for long-term oriented and focused participants, but there are potential risks around the corner. We want to enumerate some of those risks. The first is really a conversation around AI. It feels like we can't go 6 inches without bumping into AI. And so what does that mean in markets? What does that mean for our portfolios? What does that mean to us as participants and plan sponsors? Navigating valuations. We're in a part of the economic cycle and the market environment where things are not, at least by the math, particularly inexpensive. And that's not a joke on inflation. It means, that markets are fairly highly valued. And what do we do about that? How do we react as both investors and fiduciaries, overseeing our ERISA plan? And then finally is the noise-resistant economy. Last year, we threw it at Liberation Day. We threw it at a government closure. We've got the consideration of an independent Fed or not in falling interest rates, yet the economy is measured by GDP is robust, labor is robust, inflation, while above the Fed's target, is robust. And it seems that markets and the economy continue to tread on. So what does that mean to us and how do we navigate that environment? So before we jump straight into markets, we're going to do a bit of a pulse check on the economy. As I mentioned, as measured by GDP, as measured by inflation or labor, the economy, things look pretty good, right? They're growing, a lot of green on the screen. But we will say that, the economy, while positive, it's not an unstoppable freight train. And there's a lot of which we could discuss about the economy. Frankly, like a good politician would, we could pull out one point of information and show you how the economy is great and pull out another and show you how it's really faltering. How we're going to summarize all this is into what's called a diffusion index, right? So we take 14 different things that are important to the economy and basically add or subtract them in a numerical way. And you can see kind of that middle line there that goes across the screen. That's kind of the line of indifference. If you're below it, the economy's, maybe a little slower than you'd like to see. If you're well above it, the economy's doing very well. That EKG looking chart there, that was 2020, right? When we had a manufactured recession and, we walked into that environment, and then coming out of it, the economy being very robust. So we won't spend time, I promise you, I won't bore you to tears with all of these underlying economic indicators, but you can see there's a lot that's kind of stuck in that neutral gear, right? The economy's growing, but it's not, that unstoppable freight train, nor is it, we're clearly in a recession. So when you look at this line, if it gives you pause or angst, I would say before, you allow that fear to jump in, we'll say kind of two things definitively. One, we've got great data on the economy going back to at least, the 1940s, kind of the, pre-World War II environment in which we have kind of a robust series of data. And, if you're worried about the R word looking at this graph, a recession, recessions really happen with two regularities when a couple of things happen. One is corporate profits stop growing. I can tell you we're in an environment where corporate profits are growing, and they've been growing at an increasing rate. And so that as an indicator is not telling us that we are sitting on the precipice of a recession. The second is recessions tend to be an environment in which obviously labor, right, employment, tends to be contagious, and you see pockets of unemployment rising and then overall aggregate unemployment rising. And while, very short-term data here has been a little bit weaker than we'd like on the labor side, overall unemployment sits, kind of in the low fours, in an environment in which, the economy is still robust. So in summary, the economy is in good shape, not great shape, kind of like how I am. I'd love to get to the gym more, but I get there sometimes. And so, it sets a good backdrop for us as we start to talk about markets and what that means for the future. So turning our eyes to markets, and we talk about what does this mean as participants, as long-term retirees and investors or sponsors overseeing our plans? Well, in doing that, first, the keyword is long-term, right? Even for our most seasoned employees that are nearing retirement, if God willing and the creek don't rise, like those individuals will still have a long period of investment in front of them. And so we need to be long-term and focused. And the way that we do that is we build 10 and 20-year forward-looking capital market assumptions. It allows us to get out of the noise of day to day, what was the CPI print today, or what was the labor print on last Friday, and focus on what matters most. And that is long-term ultimate returns and long-term ultimate risk on a go-forward basis. This isn't in the rear view mirror. This is our expectations of the future. Now you can see, as we looked at this exact information this time last year, and we've rolled it forward to 2026, on fixed income, our long-term assumptions, the year-over-year column there, are falling modestly. Right? That's a result of fixed income generally did well last year. Yields, which is, think of it like the coupon, right? The source of return across fixed income, have fallen modestly. And so that means we have a modestly lower expectation for fixed income. Now that's just a year over year. If we zoom out and we look at this over a longer period of time, the last 20 years, fixed income is still fairly attractive. And I realize there's a lot going on in this chart, so let me give you a quick tour. Each of the gray bars are a different asset class. So cash is an asset class, for example, on the left, or the fourth bar in the ag. That's basically like the S&P 500 of fixed income, the Barclays ag. The higher the dot is towards the top of that graphic, the less expensive it is, or the more attractive it is as investors relative to the last 20 years. And you can see, on average, most of the dots are above the midline, and so things are pretty attractive there. Now, while modestly lower than it was the previous year, still overall attractive. Now, there is one exception to this rule here, as there is always. On the bottom right, as you see spreads, which is the additional compensation that you earn for investing in riskier fixed income, so corporate credits or non-investment grade credits, and that's at all-time tights. And so as we look at the risk there, we don't think it's being compensated as well as other parts of the market. But overall, fixed income is still fairly attractive. Now,
Brad,
yeah, go ahead, Joel.
most of our clients have either kind of an aggregate bond fund in their plan, or a short-term government bond fund, or cash equivalent. How does this data translate to how they should be thinking about the funds that are in their plan?
Yeah, as I mentioned, that fourth bar there, that Barclays Ag, that is either through a passive or active fund. That's the primary benchmark that would be seeking to replicate. Cash on the left, that would be most equivalent to money market, similar to stable value, but slightly different in a host of ways. Regardless, both of those indicating, hey, these are fairly attractive levels for the potential return. That's beneficial for all investors, but especially those investors nearing retirement. As you near retirement and you're in retirement, the goal, right, is to replace your biweekly or whatever the cadence is of income. The ability to do that through fixed income when yields are higher is more easily achieved. And so for participants, and that's on the core menu, right? If you also have QDIA, like a target date fund, that is automatically moving you towards a more fixed income oriented investment posture as you near retirement. And based on this data, that's a healthy thing in today's environment. Now, flipping to the equity side of the ledger here, somewhat of a similar story, right? We see that year over year, that our forward-looking assumptions are a bit more modest. That's because markets did really well last year. Emerging markets, countries like China or South Korea, et cetera, up 33% last year. Developed international, up almost 30%. The S&P, the laggard, albeit, but still up 18%. And so all else equal, markets have come to fairly full valuations. And so year over year, those have dropped modestly. Now, one of the reasons that markets, especially here in the US, have fairly full valuations is AI. We've already talked about it. We talked about it as a key theme. And there are certain segments of the market that are trading at very full valuations because expectations are very high, right? So that's the Mag 7 that you would read about. It is NVIDIA or stocks like that you'll see in markets and really making headlines. And one of the questions that we've been getting more and more from participants and plan sponsors is, what do I do about AI? On one end, it's a risk or a concern. How should I, address this in my plan? On the other end, it's how do I get more of it? Should I have a dedicated investment in my plan that is focused around AI? And so this question of kind of the AI bubble continues to rise. And we don't use the B word lightly, bubble, but we recognize that it's on the top of minds of investors. Now, we're here to tell you, we don't know if AI is in a bubble. We don't, no one knows if AI is in a bubble. But for a plan sponsor or participant, what do I do about this in my plan? And especially for those that maybe are receiving questions to say, hey, we should have more AI available to our participants. It's the thing that's working in the market. Well, we would actually counter and say, well, let's first start with the facts. And that's that AI is already in your portfolio. If you have a portfolio, and you likely do, that in your core menu have the S&P 500 or you have international stocks, just the S&P 500 alone has almost 40% of its exposure in AI or AI-related companies. So if any participant calls you as a plan sponsor, or if you're a participant in a plan and you say, man, I wish I had more AI, you say, well, you already do. You've got a pretty good chunk in there already. Now, as we talk about bubbles and we talk about full valuations, it's important to put that in context of long-term. Again, as retirees, as long-term investors, we have to stretch this over the horizon of which we're trying to achieve our goal, not a single year or quarter or month. And, in markets where you have full valuations, volatility is a regular thing, right? It's an unfortunate and somewhat necessary evil of capital markets is that volatility is kind of the flip side of the coin of opportunity. Without it, we would not see the type of returns that we do in markets. And volatility happens regularly from your germane 5% drawdown, which in theory could happen in a day, to your more kind of bone rattling, 20% or more drawdown or recession that we talked about briefly. But on average, right, a 20% drawdown happens about every 7 years. And so, we as allocators, as investors or participants in the plan or as a plan sponsor, we need to recognize that volatility is an inevitability. And part of what we do through savings rates, and plan design features like auto enrollment, auto escalation, et cetera, help us offset some of that risk and volatility. And then plan menu design through diversification of asset classes, through thoughtful utilization of target date portfolios with a downward risk sloping glide path or managed accounts that help build a more customized portfolio. They recognize the fact that volatility is the unfortunate evil of investing in markets. And so we need to structure a plan and build a plan to address it. Moreover, if we look beyond just kind of the short horizon and we think, longer term, right? Especially young participants in our plans in their 20s or even 30s, they have multiple decades ahead of them of which to save and retire. And this graphic, if it looks like an eye chart, it kind of is, almost by design to really hit you in the face, is that each of these is calendar years going back to 1994. And you look, the y-axis here is the further you go down the chart, it's the annualized return. And so basically there were 2 years, 1999 and 2000, in which you started, where it took kind of 10 years to dig out of a return, a negative return. But anything beyond that 10-year scope, 11 years and on, albeit in some instances very modest, you have a positive return. And so we as very long-term investors trying to save for retirement, replace our base income, if we focus on that long-term, use kind of those thoughtful saving rates, use that thoughtful design and portfolio construction and utilization of the core menu, it really puts us in a place to have a higher probability of success. So I'll pause there, look for questions in the queue. And if not, Joel, we can turn it over to you on the ERISA update.
Not seeing anything in the Q&A, so let's progress. Let's dive in a little bit on the ERISA side. So for those of you that are unfamiliar with my background, I apologize. I am a former practicing ERISA attorney, so this is kind of my area of specialty. I'm going to dive into 3 topics today, and I'm actually going to substitute one away from the end here because I have some more kind of pressing news that I think is important to roll out. But let's start with where we're sitting today. So remember, at the end of the prior year, the IRS comes out with plan limits, right? And earlier you saw a slide where Brad was talking about some fuzzy data. Well, what's not fuzzy is where the plan limits fall out for 2026. So as you can see, when you're comparing these on a line-by-line item, we've got increases across almost all of these, right? So people are able to save more. They're able to push more in to catch up. The annual compensation limit has crept up. The one thing that has stayed constant is the definition of highly compensated employees, which means that that threshold that we're using to measure between your HCEs and your NHCEs, for those of you that have plans that have to pass non-discrimination testing, that hasn't changed. But otherwise, across the board, this is good news. Sometimes there are years where the COLA doesn't really move the ledger. This year, we are allowing for folks to save more. And so we have to make sure that our communications to our employees and our personnel are letting them know that there's an opportunity for them to increase and enhance their savings for the future. So I'm excited about that. That's good news. The other item that I wanted to talk about a little bit was an amendment that occurred in 2025. And this is talking about the voluntary fiduciary correction program. So as a reminder, the VFCP is a corrective action program that the Department of Labor rolled out all the way back in 2002. Why is this important? It's important because you have to remember that the big bad regulators are not necessarily out to get you. Their goal is not to try to trap you with errors that occur with the plan. And they created this program, and this is the Department of Labor's. The IRS has the VCP. They created these programs specifically because they wanted you to be able to go back and voluntarily correct your plan and get it back to where it was supposed to be without there being the specter of government weight on you, without the specter of there being heavy penalties, etc. Well, what you see here are a little bit of the VCP violation corrective program and the process. So first of all, you've got to make sure that you're eligible, and that's contained in what's called a revenue procedure. And there's a few hoops that you have to jump through to determine if you qualify to use the VFCP process. The process is usable for very specific violations. So again, it's not any issue that comes across your plan, but there's a list that is provided by the Department of Labor on their website. And ultimately what they want to do is for you to get the plan back to where it would have been had the corrective action or the violation not occurred. And then ultimately, there's the need for you to file an application for VCP and take care of the attendant documentation. So in the event that the Department of Labor comes in to take a look at it, you've got everything aligned, you've got everything documented, they see that you've done the right thing, and that indeed the plan is in the place that it should be. Now, that said, we did have an amendment last year. And so this is something that's new to the VCP program. It's the self-correction component, or the SCC. So under the SCC, there's not a need anymore to go through the VCP application program anymore. And on the next slide, you'll see that there are two types of violations that you can use the self-correction component. One is for delinquent transmittal, and that's for either delinquent transmittal of participant contributions or deferrals, or loan repayments to the plan, or inadvertent participant loan failures. So this is great because this is going to streamline the process if either one of these occurs with your plan. And these happen to be the areas in which most plan failures tend to occur. So these are the types of things that you now no longer have to go through the full-blown application process. So here, again, what it's looking at are delinquent transmittal. And that's because technically under ERISA and the IRS, the Internal Revenue Code, a late transmittal is a prohibited transaction. Essentially, it's looked at like the plan has made a loan to the employer in an inappropriate fashion. Now, you're allowed to use the SCC rather than doing the full-blown application if the lost earnings are under $1,000 on each occurrence, and that's on a per payroll period. So in other words, it's pretty broad in terms of your ability to use it. Now, you are going to be asked to still use the Department of Labor's calculator, which is available online, to calculate the lost earnings that you're going to have to make back to the plan to make the participants whole. But again, that makes this process that much easier. There's an actual online calculator in which you just plug in the data, and it's going to spit out the number that you have to make the plan whole on. Now, you have to self-correct within 180 days from the actual withholding. That's important because it does give you some flexibility, but you're not allowed to just kind of delay, indefinitely. And you also have to not be under investigation ultimately. Now, what you're going to have to do is provide the SCC notice, and you can do that through the EBSA's web tool. And again, remember, the EBSA is the Employee Benefit Security Administration. This is the enforcement wing of the Department of Labor. It's the people that you are most likely to encounter if you've got an investigation or an examination into your plan. In addition, you just need to complete the documentation. And you see, listed here a few of the items that are going to be required. the retention record checklist, a penalty of perjury statement, and you have to provide them to the plan administrator. Again, that's typically going to be someone that's named in your plan document. Oftentimes, it is your company itself that is named as the plan administrator, and you need to keep those records internally in the event the Department of Labor shows up at a later date and they want to kind of crawl into the process that you undertook. Now, the next slide kind of shows a real high-level kind of Q&A. And essentially, if you're able to answer yes to all of these and no to the last one, well, you qualify to use the SEC. So, does the plan provide retirement benefits? I'm going to guess if you're tuning in today, that answer is probably yes. Were the contributions or loan payments remitted within that 180 days? Did you use the online calculator to figure out the lost earnings? Were they computed from the date of withholding? Did they amount to $1,000 or less for the delinquent contribution? Were any other items that needed to be paid or made whole undertaken? And is the plan under investigation? Again, if you can answer yes to all of those and no to the last one, you're going to be in a good place. Now, as I mentioned, no need to go on to the next slide because I actually want to talk about something that just came out in the news, so it's very topical. And it's about the Employee Benefit Security Administration's enforcement priorities. So again, because I mentioned the fact that these are the folks that are most likely to interact with you in regards to your plan, I would think that all of you would want to know what are of import to the EBSA and what are maybe being deprioritized. So remember, the EBSA's goal is to protect the integrity and the health of retirement and health plans. So, and this changes from administration to administration, right? Each administration kind of restocks the head of the Department of Labor, and they might have different priorities from the prior administration. And it usually takes about a year for the administration to really get their feet under them in terms of what they want to prioritize or deprioritize. So heading into 2026, the EBSA has said that they're going to prioritize, first of all, health plans. So they've slowly been building their expertise in the enforcement wing for health plans. So I would expect increased examination activity on your health and welfare plans. Cybersecurity is another one. Remember, a few years ago, the EBSA provided guidance in regards to what fiduciaries should be looking at in regards to cybersecurity. Also remember, if you're one of our clients, we have an annual report that we can provide you on the cybersecurity of the service providers that are operating with your plan. Again, we don't expect, nor does the Department of Labor expect you to become cyber experts, but they do want you to take a look at kind of the moving pieces and gain a level of comfort that the cybersecurity of your participants is being looked after. So again, let's look at that report on an annual basis. You can file it in your fiduciary file. They're also looking at a review of potential conflicts of interest. This doesn't really change all that much from administration to administration. Conflicts are an ever-present concern for the Department of Labor. So as a reminder, it just behooves you to continue to be front of mind about any potential conflicts and to explore them fully and make sure if there is a conflict that there's a mitigating factor or that you are hearkening back to your primary responsibility of fiduciaries, which is acting in the best interest of your participants. Another is the investment selection in 404C plans. So remember, in these plans, participants are empowered to make the investment decisions in regards to their investment elections. The Department of Labor is concerned is whether or not mid-sized plans are falling short of their fiduciary responsibility. So again, we're looking at plans probably in the $10 million to $75 million range that the Department of Labor wants to come in and just make sure that you've got buttoned up processes. And then underfunded defined benefit plans. That's another area in which they're going to increase their enforcement focus. What's been deprioritized, and these were two items that were under major focus under the prior administration, are ESOPs, so employee stock ownership plans, and missing participants. So you might recall that the prior administration leaned very heavily into the location of missing participants, provided you with guidance, et cetera. that guidance still remains available and prevalent, but it's not necessarily going to be part of an enforcement action from the Department of Labor under the current environment. So that brings us to the end of the 30 minutes that we had to spend with you. I don't see any additional, well, let's check the Q&A.
We do have one question in here, Joel. You can't get off that easily.
Okay.
So there was an ask for clarification on key employees and whether vested or unvested stock positions would be included in that determinant.
Yeah, that's a good question. And the reality is we'd have to dive in a little bit more deeply into the fact set to determine, the design of the program. Because if the design of the program ends up being under a 409A program, that might change the answer. So I would recommend that you reach out to your plan advisor and ask them that question. We'll be able to dive in a little bit more deeply and provide you a pretty detailed response on that. So I want to thank everybody for joining us. A copy of this recording will be sent to you, as will the slides. We wish you all a happy and healthy 2026, and we thank you for your partnership. We greatly appreciate you, and thank you for joining us today. Brad, thank you for your time. Thank you for your experience and your expertise.
Thank you all.